There's nothing wrong with buying a home, but you just have to make sure that you can afford the home that you're buying. That means you gotta afford the down payment, you gotta afford the monthly payment, and you gotta afford the moving costs. That means you gotta afford the movers to get your stuff in the home, and then you gotta afford whatever upgrades, renovations, repairs, and new furniture that you wanna purchase. So you gotta factor all these three things in there, and if you can afford it, hey, go out and buy a home. Remember, you're buying a home because of the memories you can make, because of the time that you're gonna spend there. So don't try to perfectly time the market and risk your family's livelihood on this gamble of a potential home that you hope that one day will be worth more money. Buy a home that you can afford, and if it makes you more money, great. If it doesn't, oh well, you bought it for the purposes of making memories. Let's talk about what this means financially, because in 2021, let's assume that this home cost $500,000. Well, in 2022, assuming that no modifications, no upgrades are made, that exact same home is going to cost 20% more, which is $600,000. It's a little bit more than 20%, but I'm going to round down for the purposes of this example. Now, in 2023, right now, the kind of consensus, general predictions are that home prices are going to grow another 5-point-some% over the next year. So if that happens, that means that home prices will grow to, or this home will grow to right around $630,000, assuming that nothing changes. I'm just looking at the projections that the economists and other officials have put out. That's what they're predicting in terms of home prices. But then let's look at mortgage rates, because remember, the actual affordability of homes depends more than just the housing price. So back in 2021, if you had good credit, you could go out and get a 30-year fixed rate mortgage for 2.5%. Right now in 2022, a 30-year fixed rate mortgage is going to cost you right around 5.5%. In 2023, right now, the Fed has said that they want to raise interest rates multiple times in 2022, still, meaning multiple times more in 2022. And they also say that they want to raise interest rates multiple times in 2023. So we don't know for sure what the Fed is going to do. I've talked about this in multiple videos, which is why if you haven't subscribed yet, make sure you do that. But what we don't know is how true that's going to be, because we don't know what's actually going to happen in the economy. There are real concerns in the economy. There's real concerns with inflation. So based off of those things, we don't know for sure what the Fed is going to do. But let's just assume right now that the Fed stays true with their word and they don't change their mind, which can be sometimes a hard thing to predict, because in 2021, the Fed said that inflation is transitory. Now they say it's not transitory. So, they do flip-flop, but let's assume that they don't flip-flop and they're going to continue raising interest rates. Well, then there's a good chance that we could see mortgage rates go to something like 8% in 2023. Now, what does this mean? Well, here you're borrowing less dollars at a lower mortgage rate. Here, you're borrowing the most dollars at the highest mortgage rate. I couldn't do all the rest of the math in my head, so I had to pause the video so I could do the math, but here's what this means financially. In 2021, if you put down 20%, that means you'd put down 100 grand on this home. In 2022, the same 20%, you got to put down 120 grand. In 2023, you'd have to put down 126 grand to buy the same home. But now the monthly payments are where it gets really interesting. Already you've seen that you got to put down a whole lot more cash to buy the same home. But in 2021, because you could get a 2.5% mortgage, it would only cost you $1,600 a month. In 2022, the same home, now because you have to borrow more dollars at the higher interest rate, is going to cost you $2,700 a month. And in 2023, assuming you get the same home, assuming that these projections are right, that home prices are going to keep rising, and assuming that the Fed stays true to their word and we see mortgage rates go up to around 8%, that means that the same home is going to cost you $3,700 a month. And this same home would have cost you just $1,600 a month just a couple years ago. That means the cost to buy the same home between 2021 and 2022 will go up by 131%, assuming these projections are correct, because now you have to borrow more dollars and the mortgage rates are going to go higher. Now, you might be hearing this thinking, just breathe. There's no way that's possible. How can home prices grow by 130% in just a couple of years when at the same time wages are growing by 5% a year? I mean, there's no way that people can keep affording these higher costs. So what's going to give? Is it going to be home prices, or is it going to be the mortgage rates? Or is it going to be something else, right? Because there's always this X factor with the government and the Fed that we can't predict. Maybe they'll change some rules in the housing market. Maybe they'll create some sort of price controls. Maybe they will change the rules on getting a mortgage. I don't know what they're going to do. But something would naturally have to give, because if people say that home prices are going to keep rising at 5% or 5 and some percent a year, and mortgage rates are going to also keep rising, it's going to make homes significantly more expensive. And at some point, people are going to say, I just can't afford these homes anymore, and they're going to turn away. They're not going to be able to continue to buy homes. And if the supply keeps rising, or even if the supply stays stationary, the demand is definitely going to be hurt. I mean, if we see this type of rise again for another year, it's going to hurt the home buying process, and that's going to change the way that home ownership works here in the country. And this is what, again, we don't know what's going to happen, right? I can't predict the future, but I can show you right here that something just doesn't make sense. Eventually you're going to hit a tipping point, but real estate has this kind of lag time. And the question is now, what is the Fed going to do here? Are they going to continue doing this? And when is this higher mortgage rate going to affect the price? So now if I take another step back and talk about this whole idea of building wealth, what do you do? Because if you're looking at this saying, I don't know if I can buy a home right now, the home costs are so much more, what can I do to build wealth and really do something so I have some assets so I can pass this down to my heirs, my kids, my whoever? Well, if you cannot buy a home, or if you don't want to buy a home, there are other alternatives. Now, obviously, in the real estate space, you could go out and buy rental properties. You can buy an apartment complex, but you still need cash and capital in order to do that. If you cannot do that, the next best thing in the real estate market would be looking at something like some sort of crowd-funded real estate. Crowd-funded real estate is where now you're not owning the entire property yourself. You're investing your money into a fund that gives you exposure to a bigger real estate property. This is not a REIT. A REIT is a real estate investment trust. That's something that you buy on the stock market. And a REIT is something where now you're investing your money into a company that goes out and invests in real estate. This is not that. Crowdfunded real estate is where now you're actually investing your money in a fund, where maybe you get actual ownership in the property, or you're getting ownership into a fund that gives you exposure to a bigger real estate portfolio or a bigger real estate property. So if you really like real estate, that's one option for you. If not real estate, then the next option could be potentially stocks. Because now when you invest your money in stocks, this could be through individual companies or ETFs or index funds. An ETF and an index fund just give you exposure to a broader group of stocks. Now you're not investing in one individual company. Now what you're doing is you're taking your cash, and instead of using it to pay off your mortgage or whatever other fees you have to pay, because the one thing that I didn't mention here is that as home prices go up, it's not just your mortgage payment, but now your property taxes are higher, your property insurance is higher, because these things are gonna be based on the home price. So you gotta understand that, you know, as home prices go up, your other costs go up as well. But now the whole idea with investing your money in stocks is now you're taking some of your monthly income and you're going to be putting your money into these stocks, into these ETFs, into these index funds every time you get paid. Every week, every 2 weeks, every month, you're just going to continually keep building up shares, and you're going to keep building up equity, not in a home, but in these companies that will now you build up ownership in a piece of America. Because that's the whole idea of home ownership, is you own a piece of America. You own some land, you own a building, but this is a little bit different. It's more of a paper ownership, where now you own paper ownership of some of the companies that make America, America. And the last thing that you could potentially do to build this sort of generational wealth would be to invest your money into your own business. Now this one's going to require the most work on your end, and you have to be a specific type of person. You have to have the entrepreneurial mindset in order to actually build a business. But now if you're investing in your own business and you own a company and you have employees, you have a whole team, you have a process where now it's not just you physically working there, but now you have this ownership of your company that you could potentially sell and get cash and give this cash to your heirs. You could sell it and invest it into a different company. You could sell your ownership and buy real estate, or you can just take this ownership of your company and give it to your heirs. So it's another alternative way for you to now have an asset that you can pass on. Because at the end of the day, the whole idea of building wealth is not just to own a home. It is to build wealth by owning assets. What are these assets? It could be real estate, it could be land. And the way that you buy real estate and land is changing, because now you can use crowdfunded real estate. You could look at investing in stocks, which give you ownership in the companies that make America, America, or you can invest your money into your own business. Thank you for watching. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. there. Thank you for watching, and as always, keep hustling.